All right, next one, AMC and Universal. So they patched up, like any other partners. One does something with the other one doesn't like, we'll break up. And then after some time, oh, let's patch up because we got nowhere else to go. So a quick history, AMC had actually banned all Universal movies from its theaters because Universal had released Trolls. I don't know, Trolls 2, Trolls 3. I wasn't following that series, but they did release a new Trolls movie only on streaming. They couldn't have released it in theaters anyway because all the theaters are closed. So AMC CEO, fired a letter saying we will ban all Universal movies from our theaters because this is not expected of them to release it on streaming media directly. But I think that happened maybe a month, 6 weeks, 8 weeks ago. Now they came back together and they have entered into agreement with Universal. Kind of give and take. Both the companies are doing give and take. And the agreement is that they will slash the theatrical window for movies from 75 days to just 17 days. So the theatrical window is a time period in which if you're releasing a movie in theaters, you cannot release it on any other media, right? You cannot put it on streaming. You cannot have your DVD out before that. So now that window has been slashed from 75 days to 17 days. The reason is, number one, customers will win. And the bigger reason is Universal had gone and released that movie anyway on streaming platform. They did it for Trolls, and AMC was pissed with that, but they couldn't do anything much except saying that we'll ban them. But at that time when we talked about it, I'm like, this is going to change the world. This bold decision from Universal could force other studio companies also to look at this as a medium. And lo and behold, 6 weeks later, we get a news that this actually has changed the world of movie release. So if what's in for everyone, right? So as a customer, it's a saving for me. Unless the movie is so good that I have to see it in a theater, I can actually enjoy it at home. Not when the movie has already become the talk of the town, while that it's been released, it's been out only for a couple of weeks. I can still stay at home, watch it at the comfort of my home. I don't have to pay per seat. I can just buy it on streaming platform and watch it. From Universal perspective, they make more money because the margins on when they sell it to the streaming companies, the margins are fatter for them. The streaming companies cut is way smaller than what AMC or Cinemark Holdings they would charge. So Universal had done anyway, gone ahead with it with the Trolls. So AMC, what's in it? Why did they come back on negotiating table, and why did they patch up with Universal? Is they need a chance to live. Today they had told that they won't screen any Universal movies. What if Warner would have done the same thing? And I'm sure all of the studios will start to moving towards streaming. So it's a high time AMC realized that the way the game is being played, that it has changed. The COVID has changed the movie business forever. And if they don't cooperate, it's their loss. So they needed lifeline. Now what they're saying is, okay, even if you stream it, at least AMC will be able to get some portion of that streaming revenue also. So could this be a new feature of the movie industry? Absolutely. So this is what we talked about earlier. Also, this will change how the movies may be released in future. So interesting move. And now I'm waiting to see how other studios respond to the same. Right. Next one, and this has been the talk of the week, is all the big tech companies, they have been in lawmakers' bullseye. So here's a screenshot I picked up from Mr. Bezos, Mr. Zuckerberg, Mr. Pichai, and Tim Cook they all taking an oath before their testimony began. So we'll spend some quick time, and I'll just share my analysis because I actually, was through the whole testimony. It was very interesting. It was quite long, but it was very interesting. So here's my take on it. Some of the charges that they raised against these companies were, for Google, most of the things were around the misuse of the market dominance to shut other players out. For example, they will modify the search ranking to favor their own products. They will, instead of showing the best search results to the customers who are coming to search on Google platforms, they will show the most profitable results, right? So there were charges against Google on that. There were charges from a lot of Republican members around how Google is deliberately shutting down or not giving enough equal importance to conservative articles or the websites. Those are being purposely lowered in ranks. So those were the major allegations around Google. Around Facebook, a lot of questions on WhatsApp and Instagram acquisition. Concerns was raised on how Facebook operate, that they go to startups. Startups think that the Facebook is there to partner with us. So they'll open up, their technology, their product, what they're going to do. And the Facebook come back and say, either you join us or we'll crush you. The lawmakers alleged that they did the same thing with the WhatsApp and Instagram. That was one of the charges. Other big charges is you'll copy the features from smaller players. Right? Snap is doing something, Facebook will copy it. Pinterest is doing something, Facebook will copy it. So there were some charges related to that. Amazon, the biggest charge is around how they are misusing their dominance in marketplace. One of the charges that they use the statistics, the data that they gather from the sale that happened from third party. They use that to create Amazon branded competitive products. It's like, I own the marketplace, so I know what you are selling. So I also know what are the products that are being sold most. Boom. If I can find out what customers are buying, creating that is not a big issue. So now if I already have that knowledge, I'll bring in my own Amazon branded products, and suddenly you will realize that if I'm a third party seller, my product doesn't get listed, higher up when I'm on Amazon to search for some product. It's Amazon's competitive product that is suddenly being listed as a top choice. So there was allegations around that. Then there were allegations around how they're forcing third party sellers to advertise in exchange for higher ranking. So they brought up some cases. It's that saying that if a third party seller pays you, whether their product is good or not, you basically rank higher as compared to others. And the third one, which I found, was how they use their power against the third party sellers, that when COVID struck, Amazon told, we are only shipping the essential products, PPE products, groceries, etc. So only the essential ones, and the non-essential ones are not available to be shipped for a certain period of time. But if you go and buy a Fire Stick, that was available. If you want to buy an Echo device, that was available. If you wanted to buy Alexa, that was available. So there were questions. Do you consider those as an essential product? So again, I think most of the thing was around why is Amazon misusing its power as the biggest marketplace. Lastly, on Apple, the same thing. Instead of a marketplace is the App Store. How Apple apply a different standards on the apps which are made by Apple versus the apps which are made by third-party developers. How the competitor apps are either not allowed or they are ranked lower on the App Store as compared to Apple created apps. And the lastly, the thing Apple is using its monopoly on the App Store to squeeze smaller players, by getting 30% of the revenue. And if some player wants to handle this whole transaction outside of the app, Apple just basically shut their app in their App Store. So the way the Apple makes money, this 30% is if I'm buying, let's say, a Netflix subscription on the Netflix app, which I downloaded from App Store, it's on my iPhone, and I go and say, renew my subscription or sign me in, and I pay it on my app, Apple gets 30% of that subscription. But if I go on, I've downloaded Netflix on my phone through App Store, but I open up my browser on my laptop, go to netflix.com, sign up there, add my credit card and pay it, Apple doesn't get anything. So there was an interesting, I think there's also a court case that have been filed by I forgot the name of the company, but their product is Basecamp. So they basically asked all their users to sign up outside of Apple Store, and then Apple kind of shut them down. So there were incidents like that in which, hey, Apple is misusing its monopoly in App Store. So some of the quotes, some of the interesting ones is this came from Mr. Bezos. What I can tell you is that we have a policy against using seller-specific data, but I can guarantee you that it has never been violated. So neither here nor there, right? So we have a policy, sure, but do we always follow it? I can't be sure of that. So something that came from lawmakers is we all think the free market is great. Competition is great. We love that these companies, American companies. What's not great is censoring people, censoring conservatives, and trying to impact elections. Something again came that Google has evolved from a turnstile to the rest of the web to the walled garden. Means Google now is not a gateway where you can find the best things on internet. It is trying to create a walled garden wherein they want to keep all the users within the Google properties, even though if there are better choices outside. Those are some of the allegations. They are engaged in a behavior that is anti-competitive, which favors their own products and services, which monetizes and weaponizes the data that they collect from users, and that compromises their privacy and creates a competitive disadvantage. Something when they were questioned, do you think Chinese government steals technology? The only straight answer came from Mark Zuckerberg. And this is his quote. I think it's well documented that the Chinese government steals technology from US companies. Most of the others, they kind of skirted around this issue saying they may be, but we don't have any direct knowledge of it. Though later on, I think Sundar Pichai and Apple, they came back and say, oh, they know one of their product was impacted, but most of them kind of didn't provide a direct answer to this. And lastly, the funny one, and this is what happens when everything is on conference and not in our meetings. I forgot to record this one, but in this one, when Mr. Bezos was talking, nobody was able to hear. We could see his lips moving, and then some lawman said, Mr. Bezos, I believe you are on mute. So don't feel ashamed of if we are in a meeting. I mean, if this can happen to Jeff Bezos in front of lawmakers when millions of people are watching that proceedings, it's okay. It's okay if I have spoken for a few minutes on mute, right? Most of the phrases that I heard, and this is across all the CEOs, I respectfully disagree with the characterization of our company, right? After every time lawmakers would say that, these are the charges against you, consistently, I see many of the CEOs coming back and say, I disagree with the characterization that's being portrayed. Second is, I am not aware of this specific issue. And the last one, we'll be able to share more information later with your office. So net, I think it was a good drama. My take was it was a good drama. It was interesting to watch in terms of what's been happening, but we'll see what the final report comes out to be. But one thing was very clear, that from both sides of the aisle, there were concerns that bigger players are getting bigger, both from Democratic and Republican lawmakers. I heard this, at least what I could figure out, that it was um, a concern. Oh, so Sachin says, you the next connections audio. Oh yeah, sure. I thought probably I just heard the, I read the word mute. I'm like, oh, is it? Then I realized, no. Yeah. And I forgot which was the lawmaker who compared them, saying, now those capitalists of Gilded Age, Rockefeller, Carnegie, Vanderbilt, and Mellon they have not gone, but they have been just replaced by Bezos, Zuckerberg, Pichai, and Cook. I felt that was a really very strong statement in directly, putting those faces on those Gilded Age capitalists. And last statement is I want to talk about is that the lawmaker said these companies as they exist today all have monopoly power. Some need to be broken up. Which one will be broken up? What's the going to be the report of the Judicial Committee? We'll still have to wait and see. But there was a unanimous kind of a theme which I could see in the committee is something needs to be done. That could mean either we break up the companies or shall we change the anti-competitive laws. So the reason why anything hasn't been done yet is, even though we say you're anti-competitive, the end customer is still benefiting from whatever Amazon has done, whatever Google has done. Our normal anti-competitive rules say that if the actions of company getting bigger is going to harm consumers, that the consumers and harm consumers means it is going to reduce the choice that consumer has, or going to increase the price that consumer has to pay for the same service, then it is an anti-competitive behavior. It's a monopoly behavior. In this case, that's not entirely true. Customers, with Amazon coming in, with Google coming in, customers have got more choices than what they used to have earlier, and they are paying lesser for the goods and the services. And in many cases, those services are just free, right? Google is everything free. They're not even paying anything. So from that perspective, it is really not anti-competitive. It's, antitrust laws just cannot be applied. So there is chatter around, we need to change the antitrust laws, which was focused solely on harm to consumer, maybe to bring in harm to, the bigger marketplace as such. So we'll have to wait and see. But lastly, I want to end, this whole market fairy section with the last quote, which says, lawmakers asked that someone needs to be broken up, and Apple was the first one to deliver it on Thursday. So lawmakers asked, companies are too big, they need to be split up. Apple says, fine, we are announcing a split. So Apple announced 4:1 split. So I've never seen companies, working so fast to please the lawmakers, but Apple did, to please the shareholders, not the lawmakers. So Apple announced a 4:1 stock split when they announced the results on Thursday evening. So that brings us to the end of this section, and that's a perfect segue for our next section, which is stock splits and how does it impact the options. So any questions, bring it on the chat. Otherwise, I'll jump onto this section after I sip some water. Because I know a lot of people might own Apple. It's a very, I would say, a lovable stock in tech community. So I want to talk about what does that mean if we are holding options in Apple, and now Apple has announced a stock split. What does that mean for those who have options in that? All right. Very quiet crowd today. Just want to know everyone's still able to hear me and everyone's still awake. Hello. Okay. I got one yes from Abdul. Thank you, Des. All right. So let's talk about stock split and what happened to options. So there are generally two types of stock splits. One is the regular stock split, which is what Apple has done. And the other ones are the reverse stock splits, which is, so in a regular stock split, you get, it's n/1 or 4 shares instead of 1 share. So if you own 1 share, you will get 4 shares in your account. But the value of each share is divided by 4. Now, why companies do this is, one reason is that they want to make shares more accessible. So Apple is what, almost $400. And if you have to buy Apple in TD Ameritrade, you really, and if you don't want to spend $400, you want to only invest $100, sorry, you're out of luck. You need to have minimum $400 to invest in Apple. But if they split their shares in 4:1, then each share will be traded at $100. Yay, now I can own Apple. I can be a proud owner of Apple share. So ideally, this should not have any impact on the stock price. It was 400, 1 share, now it is 4 shares, each of $100. The other way is to split is something called reverse split, which is opposite. That if you combine shares, a larger number of shares, and the end result is 1. So for example, OIH, they did a reverse split of 1:20. So 1 share out of 20 shares. So if in this case, if I owned 200 shares of OIH, after the reverse split, I will just own 10 shares of OIH because 20 shares were combined to 1 new shares of OIH. So 200 shares that I owned is now converted to 10 shares of OIH. So that's called a reverse split. Now, why companies do reverse split is many of the exchanges have the guidelines on the minimum price. And if your price, and I've seen this very, very common among penny stocks, and leveraged instruments, is if your price go below that minimum price, then they just do a reverse split, which increases the price of individual shares. So for example, OIH, if I have 200 shares and each share is trading at $1, after the reverse split, each share would be trading at $10. So, sorry, each share would be trading at $20 because they combine 20 shares into 1 share. So now, if the exchange guideline says that you need to have minimum, you need to have more than $1, now I can still trade on exchanges because now my share is worth $20. So leverage ETFs, which have got an inherent drag built in, which keeps on, going down and down. You will see very common reverse split is very common procedure among those. Example, TVX. So let's look at what happens and how those options are getting impacted, right? If you have option trades on this, what will happen to those option trades? So let's talk about the standard stock split first. Means you get more shares, but the same value. There is no free money that is over here. I want to be very sure. So if you held Apple shares worth $1,000, after the split, you will still own the stock worth $1,000 only. Just that the components have changed. Stock numbers have increased, stock price has gone down. So let's take an example of how it impact option. Let's say your original position on a stock that you had was, you had 100 shares worth $100 each, means you had $10,000 worth of total stock. Okay. And you had an option on it, one covered call at a strike price of $105. So in that case, if they announce a 2:1 standard split, means for every one share that you hold, you will now get 2 shares. So with that announcement, now your stocks that you will hold, you used to have 100 stocks. Now suddenly, because of the split, you will have 200 shares in the portfolio. Okay. Now that's from a number of shares in the portfolio. But like I said, there is no free lunch. Over your overall positions of a shares was $10,000. It will still be $10,000 after split. So that means the new stock price of individual stock will be just $50. So that makes the math really clear that if you had, because then after the split, you will still have, you had 200 shares. Each share is $50. That makes it $10,000. You started with $10,000. After a split, you're back to $10,000. No free money. So that's what happened to your stock position. Now, from an option position perspective, you had a $105 covered call. So the notional value of your option was 10,500, right? Because each, so how does that, question I see, how does that affect premium price after the split for new contract? That will be, in terms of how much is the interest, and the market makers will adjust it, but the prices will change. So your pre-split notional value was 10,500. Again, no free lunch. It will still be the same even after the split. So your 105 call option will now be, instead you will have a 2 call options, and the notional strike price will become $52.50. Instead of it being a 1 call option and 105, now you will have a 2 call option, which will now be equivalent to at $52.50. So that's what your new position will look like. So your overall exposure still stay the same. You will have 200 shares at 50, and your 2 calls will get, your 1 call at 105 get converted into 2 calls at 52.5 strike. Okay. So the regular split is still okay. The reverse split is a little tricky to understand. So for example, if you have 100 shares worth, we continue on the same one, you had a $10,000 worth of stock, and then you had a 1 short call at 105. Now the reverse split is for 5:1. Means now the 5 shares are combining to create 1 new shares. So then in your portfolio, instead of 100 shares, now you will have, oops, too big. Instead of that, you will have now 100. 5 shares are being combined. So you will have 20 shares in your portfolio instead of 100 shares. But you not gonna lose anything. So the stock price of individual shares will be adjusted. So each individual share will now be worth $500. So that pre-split, your total worth was $10,000. Post-split, your total worth still remains 10K. So that you don't gain anything, you don't lose anything just because of the stock split or reverse split. Now let's look at what happened to options. Again, there's no change in the notional value. When you started, the notional value was 10,500. Now your 105 call option will become equivalent to 525 because it will get adjusted. Now, when this will be kind of your new strike price at which your stock, if you're looking at it, is my stock in the money? This is what will define if a stock goes in the money or not. So now your stock is at 100 and your original contract was 105 strike. Remember, that's what we started with. Now you suddenly see that after reverse split, your stock is at 500. Hey, this is in the money. Looks to be in the money. Means I can exercise it and I'll make money out of it. Or if you have sold it, someone else will exercise it. You have at a risk of early assignment because this is deep in the money. But that's not the case. The stock will have to move to 525 to be really in the money for the after the split. So reverse split is a little, you need to be a little cautious. Don't suddenly get panicked when you see that your contract still says that you hold 105 strike call pre-split and the stock is not trading at 500. Doesn't matter because it's still not in the money. So that's one important point I wanted to bring up is if you have an options on the stocks that are being split, be a little careful in terms of what's happening to your option prices or how will they get in the money. And the other thing is that your brokerage platform, or for example, so generally the options control 100 shares, but if we are doing a reverse split, now the option will control only 20 shares instead of 100. So on the brokerage platform, you will see a new chain in an option chain, which will show you that these are not the regular ones, but these are the old ones, which does not control 100 shares, but they only control 20 shares. So for example, we took an example of OIH, right? These are the standard options, they control 100 shares. But here you will see 18 September 5 by 100. Any contract in this, you only control 25 shares. And this came up because OIH went into a reverse split of 1:20. So there are regular options post reverse split listed, and then there are the pre-split options. They have changed to control only 5 shares. These are irregular ones. And generally, I see that if you are trading in or doing options in any ticker which has gone through reverse split, just be careful which option chain you are picking, because there will be very less volume in this irregular option chain. And these are there because some of them option contracts that were initiated pre-split, they may still be open and hence they still have these. But no one is going to initiate new trades on this irregular option. So be careful. Watch out which chain you're picking up, because you will see both the regular and the irregular ones listed for the same ticker. And this you will see mostly for the options for the stocks that go into reverse split. Okay. All right, there was another example of reverse split which is not clean, which is not 5:1 or 10:1, but it's a dirty one. I will skip that for now so that we can move on to the trades. But if anyone have a questions on this, ping me in a Slack and I can share, how does that work out. We have everything listed here. The quick example I looked at was USO, because they did 1:8, and now you cannot divide 100 shares by 8. So you end up with 12 shares and then some cash positions and stuff like that. But I'll skip that one for now. Just want to move on to our next section, which is our trades. All right, any other questions? All right, so let's move on. All right, so let's, I want to look at some of the trades like we always do. We look at the trades from a previous session, then we will also look at some of the trades that at least I have done in this week. And then we'll look at the trades that someone else have questions. And, we can dig deeper into it. So I believe it was, Des had some question earlier. So I think it was Des. Yes, so Des, if you don't mind, can you maybe post that question once again, and I'll go through that now. Thank you. All right, so let's look at something on XLU. So XLU, we had a strangle, which I closed it for profit. So these are the two trades that I closed last week. Then Stoneco. Again, Stoneco, we talked about, I closed one trade last week and then put another one. And now this one also came into being, it hit my profit target much sooner than I expected. It just took 10 days. I'm like, I'm closing it. I'm still bullish on it. So I added another trade to it. Let's look at some of the trades that we are still holding. In some cases, just waiting for a decay to come out. In some cases, defending. And we'll go through all of that. Right. So let's look at the first one, silver. Silver, like I said, silver has made a move that we haven't seen in decades. So silver is something that I'm being challenged because I had a straddle in it. When I say challenged means, yeah, we are losing money on it. We're trying to defend it. But is it that which for which I'm worried too much right now? Oh, no, it's fine. I mean, the position is small. So it's not that I'm too much worried about it. And that's the beauty of, don't go big on the first trade. So for those who have joining it, for the first time. So I had initiated a trade of a straddle in silver at 16.5 when silver was right here. Did a straddle. Lo and behold, I have no idea and no one knows what, stocks would do. It started moving high. Okay. I did only, in small number of accounts. So a contract. So I had still kept money on the side to add more to the trade. I did another one, straddle at 18 to bring our break even, to make our break even still wider. Silver continued to move. I did another one at 20. Right. And then silver continued to move. So what I did on Friday, now I realize that 16.5 straddle is too far too out. I expect silver to retrace back because these moves are parabolic moves. They generally don't last too long, but you never know. Even if it retrace, it's not going to come back all the way to 17 or 16, right? So now I'm looking at which trade should I need to adjust or defend. So we moved silver out from August to September. So now you see I have a September. I don't have any August 16.5 call. I have a September. Collected some more premium. And then I also put a defensive trade on put on September so that if silver continues to defy us, continues to move against us, we collected more premium to reduce our losses without adding any additional capital. But I'm still holding the other ones. So that's a quick summary on what's happening on the silver front. Gold. Again, I have multiple positions in it and we'll continue to look at gold. Oh, how do we get the particular? Okay, let me just. Oops. GLD, let's look at gold. Gold is all the way to 105. If you really look at it, shows that it's too far away from break even. But remember, Thinkorswim doesn't take into account the profits that we've already taken in this trade. So from the real profit or loss perspective, it's not that we are losing $2,000 on gold. But I don't mind losing on this option trade. This is one of the trades which I would love to lose on it, because the reason I put this trade is I hold gold in my 401k portfolio. And this was a kind of a covered call trade. I had only one naked call on gold. Let me just pull up from August 1. And then I have a defined risk on the other contract. So I hold 200 units of gold in my 401k. I'm okay to lose on the option trade because I've gained a lot more in my 401k. So this is kind of a good problem to have. If I only look at my option portfolio, I might say, oh, I'm losing money. But overall, I'm okay to lose this money because it sounds good for overall portfolio perspective. And I am thinking to do probably such trades a little more because the loss over here would reduce my current tax liability. And the gains, if I, for example, if I were to get off this position and take a loss here, I'll sell the stocks in my 401k, but I don't have to worry about paying taxes on that, right? So I'm thinking if, maybe do similar stuff on some of the shares that I hold in my 401k. So this is, I'm not worried about losing money on this one. Next one, Home Depot. Home Depot, no change in position. We're still holding it. Like I talked earlier, I have a covered call on Home Depot. Covered call is at 235. And the Home Depot is now at 260 or something. I'm starting to have little seller remotes. Hey, I could have made a lot more money than I've made. So I actually did an inverted strangle to collect little more premium. We collected another $3 of a premium. A net, it's still a profitable position for us. So don't get me wrong that, hey, we are losing money on this covered call. It's still a profitable position for us. We earn whatever 15-20% return on this one. Only thing is I'm trying to squeeze a little more, maybe increase that 20% to maybe 30%. That's the only stuff. But I'm long-term bullish on Home Depot. So I also have a September position wherein I sold a short put on a Home Depot at $250 for September. So these are the two positions on Home Depot. Not worried about it at all. The August one was our covered call. We are already making money what we thought we wanted to make. Now I'm trying to squeeze a little more. The last drop of blood out of this trade. And the other one is our bullish trade. Let me see if there are any questions. A question from Gariel. Do you prefer cash secure naked put or a vertical spread? So I depend on what type of stock and what's the price is. So if it's a big priced stock as compared to what my portfolio can hold, I will do a put spread. Say if it is $200 stock, $300 stock, and I am not too bullish in terms of that. If a stock falls down 20%, I would want to continue on it. In that case, I will do a put spread. Things like Amazon, I would like to continue to hold it forever. But if I do a naked put, it's going to consume so much of a buying power that I can't do any other trade. In that case, I will do a put spread. Home Depot, I would like to hold it for long. Even though it is $250 stock, and my portfolio can hold up the margin that I need to put up for doing a naked put, I'll do the naked put. So these are the, some of the decision-making points that I go through it before deciding, should I go naked put or should I go vertical put spread, right? Because stocks could fall 20% tomorrow. And if I have only the naked puts, what happened to my margin, my buying power? Suddenly it will shoot up the buying power requirement, and then I need to come up with additional capital. So in that case, if I'm too much afraid on a buying power, if I've already used a lot of my capital, I'll go the defined risk. Question from Eric. Vivek, was this a short straddle? Yes, it was a short straddle on SLV, which means I sold a put and a call, and now SLV. I have had a profitable trades on SLV earlier this year, and I was just continuing the same streak. Who knew that what SLV will do? So they made a moves that they haven't made in decades. So only thing which can save you from these moves is that, hey, I haven't put 10% of my portfolio money into this trade. Right? It's less than 5%, which is fine. Even if this goes bad, or 95% is still okay. I hope, Carol, that answers the question on cash secured naked puts versus vertical spread. Okay, thank you. All right, next one I want to talk about a PayCom. PayCom, we did a vertical spread and I am still holding it. PayCom is, and thank you to Abhishek. I saw that he put up a new earnings calendar and actually PayCom is reporting the results this week. So let me bring this up. PayCom. So this is the vertical spread on PayCom. Maximum, this is $50 wide spread. So at the maximum, the buying power on this could be 5,000, even if Paycom goes to, $100, 190. I'm a vertical spread on this. When I put the trade, the stock was at almost $305. So it has moved against us, which is fine. We still have a lot of time in this trade. It is expiring on 18th September. Earnings are coming up. If earnings are any good, the volatility will be sucked out of it. The wall crush will happen. And if the stock operates in the direction, this may become profitable. If this does not become profitable, I will be happy to take assignment on this and maybe, and then hold it. I probably won't hold the 100 shares. Maybe I'll close the trade and buy some 20 or 30 shares at a lower price. If it falls down, I'll be happy to acquire some units for this one. And we'll go through it. Today, the deep dive is on PayCom. So that's the reason for this trade. All right, next one is Lululemon. Oh, Lulu has been a winner for us till now. Every time it's around 4,000, 3,000 to $5,000 capital is what it needs. And then it delivers us, 20, 30% returns in 20 days. So which has been great. So I'm continuing to play Lulu. At a price point of 290, I'm bullish on it. Won't mind holding Lulu in my portfolio. But if it blows through the call spread side, there is no risk on the upside. We'll still make some money on the upside. But if it stays between 330 and 300, we'll exit at a max profit level. So right now it is making money. It is making what, $235. Right now the margin it's consuming is $2,600, which is close to 10% return on capital. And when did we add this trade? We added this trade on 21st. So 10 days. We've been in this trade for 10 days. It's 10% ROI. I just still want to wait for it because it's not threatening our position, right? Our break even is 292. So I'll still wait for some more premium to come in, the more decay to happen, and then we'll close it at our profit target. I mean, it's the same story. We have done this 2 or 3 times earlier also. Next one is a Tesla. Tesla, we've been have so much chatter around Tesla. I am bearish on Tesla, but then given a right price point, I'm bullish as well. So this could be an eye test on Tesla, but so because I'm bearish on Tesla, I started with a call spread, and but then I have seen that every time I do a call spread in Tesla, it always come back to bite me because it keeps moving higher and higher. So this time I looked at it at some price point. I should be okay to buy Tesla, and that price point was $900. So what I did was I had a call spread, and then I also sold a put on Tesla, which is a $900 put on Tesla, and a call spread at 1530, 1540. So if it does what it does to me multiple times, goes higher, at least I'm not losing any money. I'll make 220 bucks. But if it falls down, that's a good position for us. I'm bearish, but everyone has a price point at which they might turn from bearish to bullish. My price point is $900. So if it falls below $900, I will be assigned. At that price, I don't mind owning some of Tesla. I don't want to own it at $1,400. No way. I don't want to own it at $1,200. But $900, I will be happy to own it. But it has gone, it needs to go all the way to $900, right? It's right now it's $1,400. Maybe around 40% it needs to fall. But if it doesn't fall 40%, but stays between 900 to 1530, we make what, 700 bucks? I'm like, I would rather do this trade, and rather than being stubborn and cocky and say, no, I have to do only call spread because I'm bearish on it. Given a right price point, everyone can change from bull to bear or bear to bull. In Tesla, given the right price point, I can change myself from being bear to bull. That's the reason why I did this trade. All right, so that brings us to the end of the trades that we've been tracking. The trades that we already had on our radar, but now I want to talk about some new ones that I did this week. Jez, could you paste the trade that you wanted to review? There was one Tesla trade. I think let me go back to. Did you have any question on that one, Des? Okay. How to get the number of loss 2100 and a profit 40K on long call spread Tesla December 2020. Yeah, this came from one of our friends in our group. So let's create the trade. It's a long call spread, means you are buying a call and then you are selling a call at a higher price point. So in this case, the long call spread is 1425 and 2000. And this is December 18 expiration. So let's go to December 18, not September, because I generally don't go December. I'm just trying to put a trade that was shared by our friends on our Slack community. It says 1425, 2000. 1425. It's a long call spread, means I'll buy 1425. Oh, so that he bought at the money. I am buying this 1425 and I'm going to sell 2000 call. It means I'm going to make money if a stock goes above 1425, and I'm going to plus this amount of premium, and I'm going to continuously make money all the way up to $2,000, because after that my gains are capped. So this is how the profit and loss diagram will look like. Okay, let me hide my existing trade. Okay. So in this case, to do this trade, I need to spend $154 per share, 400 shares, which is in this contract. I need to spend $15,500. Say it's 155, right? Just for simplicity's sake. So that it's easy for me to just come up with the round numbers. I need to spend $15,500 to enter into this trade. So, and my max loss is limited to 15,500 because I'm buying a spread. The maximum that I can lose is what I put in. So as you can see in this profit and loss diagram, the maximum you can lose here is, if I bring my cursor here, you can see in this corner, keep an eye on this corner where it shows the yellow line is what shows at expiration. Maximum I lose is 15,500. Doesn't care, Tesla goes to 900, 800, or goes to zero. So that is the max loss. And the maximum profit is I'll start to make money if Tesla start to go higher than the amount of my strike price plus the premium I paid. So strike price is 1425. I paid a premium of 155. What's the total? Math geeks out here. What's the total? 1425 is my strike price. I paid a premium of, oops, not 555. I paid a premium of 155, 0750, 1570. So I start to make money if the stock has to go higher than 1570 and stay higher than 1570 on the expiration of this trade. If that happens, that's my break-even point. So this is my break-even point, which is 1570. Beyond, and I will continue to make money on this one as Tesla rises. As you can see, this number will continue to rise. As I move my cursor, Tesla goes to 1800. My profit is 21,000. Goes to 2000. That's my maximum profit. After that, profit is capped. Yeah, you're right. Yeah, I got my math wrong. So I was never strong at math. It's 1580. 25 plus 55 is going to be 18.70. So thank you, Puneet, for the correction. So the maximum profit is 42,000, which happens if Tesla stays at or above $2,000 at expiration. After that, it goes to 2,500, 24, and 2,400 doesn't care. My maximum gain is capped at 42,000. So that's what I think it was Jignash or someone shared that when I was interested in this trade, you're risking 15,000 to make 42,000. And that was the trade. So I hope now this is clear. This is how you can find out your risk to reward ratio. All right. So Dave says, no, the loss is not 2,100. So what? Okay, so let me fix that. So what he said that if the Tesla goes below 1360, no, that's not going to be the case. So the other thing is, now this what we are showing is at expiration. If you want to exit the trade before expiration, what he mentioned that he has got a stop loss if it goes below 1360. Let's say, and let me make it clear, right? So when you're looking at an expiration, let me just pull up something else for you. Okay, this might be, I've actually never shared this one earlier, but let me bring this up. This is how you can find out what happens to your positions, not at expiration, but before expiration, right? How your positions would move. Oh, that's too much. Now what I'm doing here is I'm trying to put together, instead of seeing only the values at expiration, I want to see what happens if a stock moves, how much money I'm making at different time zones. So pay attention here. Now I've drawn the lines, which is for 1st of August, 31st of August, 30th of September, 30th of October, and 29th November, right? Let's make it 35, December 18th, right? So let me get closer to December 18th. Okay. So I think that's as close I can get to December 18th. Now, if you recall, this red line is December 15th, which is the closest one to expiration. This will tell us how closer at expiration. But let's say I can close this trade anytime. And I don't have to wait until expiration. Say Tesla move against me. Today it is 1425. It has come to, let's say, 13, let me put it at 1360, 1350, okay, 1358. Can't do anything closer to 60, right? Now, if you look at that in next 1 week, oops, okay, it doesn't allow me. Let me put it 13. Oh, okay, 1362. If this is the case, if Tesla is here at 1360, pay attention to the lower left box. If Tesla comes here at 1360 on 8/1, if I close the trade, I'm only losing $1,200, $1,300 at that point of time. If Tesla moves here by 9/4 and I close the trade, I'm losing only $1,763. If it comes here at 10/8, I'm losing $2,700 only, not the whole money. But if Tesla reaches here at 12/15, given current implied volatility, given everything else as of right now, I will lose $13,000. So when when someone has said that we're losing only $2,000, probably would have looked at not holding the position all the way through expiration, but coming out much sooner than expiration. That's why it would be. But because at expiration, if you're holding it till 1360, you're gonna lose $15,000. So I hope that clarifies. Dave says, why there are two of me, Dave C and David C. You need to replicate. You're trading too much. One is not enough. Sorry, just kidding. Dave says, better way to make sell monthly, like it for OTM around 1,000 or below. Yeah, if you are willing to buy, don't mind holding it. And if your portfolio is okay to hold, to the buying power that is required for doing a naked put, sure. I mean, I would do that. I'm okay at $900. So that's what, once my, this trade, once I close this, probably I'm going to repeat, rinse and repeat on this one. Because, hey, there is a price spot at which I'm willing to buy. I'll probably do this trade again. Maybe not be at 900. We'll figure out where the Tesla is when I close this trade. But there will be a price point at which I will be willing to buy, and I'll probably repeat this trade. All right, so that brings us to the end of the previous week. Let's quickly go through what I looked at this week. ServiceNow. So last week's session, we looked at ServiceNow as a company, and what they do, what their balance sheet is, how they earn money, what's the tailwinds on the business, the management. And that point of time, I did mention that I'm getting bullish on this one. Though the price point of 430, 440, I'm not willing to buy. But again, there is some price point at which I will be willing to buy, and that's why I did this trade. So ServiceNow, I sell a naked put on ServiceNow at $400 strike price, collected a decent premium of $13. So if I were to acquire this share, my cost basis would be 386 on 60 cents, which I think I'm okay to own ServiceNow at that point. Now, the amount of buying power that it consumes is okay for my account portfolio, but be sure that this does not become more than 5% of your overall portfolio. For me, it is not. That's why I've done it. If it were, I would rather do a put spread to contain the buying power. So it's making some money right now, but let it decay. I'm not in a hurry. We have a lot of time till September. NEO, I've been trading in NEO for quite some time. Took some gains off. I'm getting back in NEO. I bought shares of NEO at $11, and then I sold a $14 covered call. If NEO goes down and start to challenge us, it's okay. Right now, I already have a couple of covered calls for August, which means my shares will be taken away. I have a covered call at $6. When I put this, NEO was trading at $4. How did I know that, from $4, it will become to $15? So I continuously want to reduce my cost basis. I had sold a call on 5.5. I sold call on 6. When it went higher, I sold a put on 6, collect more premium. Then I bought shares and sold call on 14. Now, some of you may be wondering, why do I sell a call? The shares can go so high, and I kind of limiting my upside gain. But remember, this only happened in recent times. NEO hasn't done much for last 2 years, which I've been holding. If I had not done these covered calls, I would not have been able to reduce the cost basis of my holding from $7 to now -$4. So I am playing with house money. There's no money, my money involved in it. But I had sold so much premium on NEO that my cost basis of owning this, if I could add all the premium, is less than zero. So I'm like, fine. I will continue to do covered call because that's a strategy which worked for longer time. Maybe last 3 weeks it hasn't, but that shouldn't change my game plan of what I want to do longer term. So that's a new trade entered into. Next one is Ehealth. Someone brought Ehealth to us. Thank you. I don't know who was that. But thank you whoever brought up Ehealth in last meeting. So I did look into Ehealth, what happened to them, and then I initiated a bullish position because Ehealth actually fell down too much. So I wanted to understand before I invest what happened here. So did some study on what this company is. They're into medical insurance. Anyone trying to help in insurance, I would like that. That's a very convoluted and very complicated process of managing insurance. The reason they fell down is they saw some customer churn. Even though the revenue increased, the guidance they increased, the CEO mentioned that they saw larger customer churn on the Medicare, but they're already taking steps to reduce it, and the market just sold off. So I'm like, I'll be okay to buy it at a decent price point. So I opened when the share was at 77. It has fallen down. That's okay. I'll be happy to own this at a cost basis of $67, and then I'll sell covered calls on Ehealth. There says NEO was around 2. I was afraid to get in. You are not the only one in that boat, because I have seen NEO from $10 all the way to $2, and what to say, will it go to 1 or 0? Nobody knew. So I didn't enter any positions at that time. But when it recovered back to $4 or $5, I started selling covered calls. But that's okay. Like I said, on NEO, now I'm playing with house money. So I have no complaints. All right, so that brings us to the last section for today. Let me sip some water and we'll do a deep dive into PayCom. Meanwhile, any other questions on any stocks, or if you want me to look at any positions or something? JD, okay, so JD, I am bullish on JD. JD has been a long-term holding in my retirement portfolio. Plus on my options, I've also been kind of selling a put and selling strangle. So because now I'm trying in many cases, I'm trying to do is cross account covered call, CACC. Something new which I'm trying is, if I hold a stock in retirement portfolio, and if I want to acquire more, I'm probably on my option portfolio, I'll sell a strangle so that I have a zero risk on the upside across my accounts. But I don't mind owning it more. So JD, that's what I do. I have a short put on JD and short put and short call on JDs. And I will continue to do that. A short put expire worthless, I'll do it again. I'm long-term bullish on JD. They are the kind of a viable. Alibaba and JD are the two big players in e-commerce in China, which is a big market. Alibaba is more of a marketplace, the aggregator of different third parties. JD kind of a store and take inventory and then they distribute themselves. So little different business model, but I'm bullish on both of them. ANET, I haven't looked into ANET in recent times. I had played at ANET earlier, but earlier they had a problem that they were too much exposed to a particular customer without naming the names. The customer was Facebook. And that was around here. I traded ANET last year. I made some money, but then they're becoming too volatile. Recently, I haven't looked at Arista networks, but the fact that there's going to be an explosion in the amount of a traffic, digital traffic that is going through. I think any company that has done a decent job on the networking gear side should benefit. Now, the rise that we have seen from 215 to 259 in kind of a less than 2 weeks, I have to dig deeper and find out, what caused this. Have they turned the corner around in terms of expanding and making sure that they are not dependent on one big customer? That's something which I need to look at. I think from technology perspective, they have a strong technology play over there. Just that their kind of a business model was a customer concentration was a little uncomfortable. Do you plan to hold NEO for long term? Yes, I will continue to play NEO just for the fact because they are right now, they are the kind of a biggest player in China EV market. And what they're also doing is not just, call themselves just as a car company. What they're trying to build is a lifestyle brand in China. So, Tesla has not done those things just yet. Even then, the Tesla has such a great fan following. What NEO is trying to do in China is that if you are a NEO not shareholder, if you are a NEO car holder, you get access to some of their exclusive facilities that are reserved only for NEO car holders. For example, you could have access to some clubs and lounges, which have got daycares in it. Which have got abilities where they can keep your kids engaged while you go out and shop. And you can have access to those facilities only and only if you are a NEO car buyer. And they kind of are forming those clubs, exclusive clubs. And this is from a society perspective, in China, it does become a symbol of a prestige that I have not only have a car, but I have access to some of the facilities which are exclusive, right? So other thing is NEO recently, they were in a trouble earlier because of the two things. Chinese government have reduced the subsidies that they were giving to electrical vehicles. So all the EV companies in China were impacted because of this. NEO 2 was impacted because of this. But now after COVID, Chinese guidelines have changed. I think one of our previous sessions, we looked at what were the tailwinds behind NEO. Some of the guidelines that have changed are on, I think, swappable batteries or something, which is what NEO does. There were some guidelines which the Chinese government subsidies will help them. Number two, they also were funded by the Ohi Prince. I'm butchering the name of that province. So if there is any native, people who are more familiar with China and how the province are named, pardon me, but it's AUHI, Ohi province, where they have their, I think the headquarters or the factory. They got a loan from that provincial government. So there is a government interest in NEO, as is the government interest in every other company in China. So there are some tailwinds on NEO, and which I want to hold it. But again, I don't want to go gangbusters, put 50% or 20% or 10% of my portfolio in NEO. I'll continue to play safe by, selling a put. And if I assign, sell a call, reduced cost basis. Right now, I'm already playing with the house money. So I don't have in real sense, I have nothing to lose in Leo, so I'll continue to stay in Leo. Yeah, oh, okay, Eric, you already mentioned it is in fact backstopped by Chinese government. Yeah, they got a loan of I think $2 billion from them. All right, so let's jump into our last section. Probably will take 20-25 minutes, and then we'll finish today's discussion. Let's talk about PayCom. Oh, okay. So Eric, yeah. So it is true that they got loans. Now, if you are investing in Chinese companies, whether the companies declare or not, let's be clear that there will be at some level involvement of government in that. Unlike in most of the companies in US, if not direct, the government may have an indirect involvement in any of the companies, be it Alibaba. I like Alibaba, respect Alibaba, I'm bullish on Alibaba. But I do understand that, this is how the business is operating in China, and I'm okay with it. So if you're okay with it, I don't see any issues in the fact that NEO is backstopped by a provincial government. I would say that it is might be a good thing. I wonder if this is a company that cannot go bankrupt. Yeah, we'll have to see balance sheet, and if there's a government which is coming to subsidize or ready to put money on it, and then they probably may not go bankrupt. I mean, the Fed is doing the same things here. So Fed is now, giving lifeline to the companies that actually should have gone bankrupt. If NEO in one of them, and if they continue to stay in that situation, probably I'll come out. But right now, they in terms of the vehicles, etc., their last quarterly report, it was better than what they were expecting. They sold more vehicles than what was expected of them. So we'll continue to watch. I will continue to watch NEO, look at their quarterly reports. But for now, I am bullish. Dave's playing Chinese. So what happens with US delist them? They probably, if US delist them, means they will be delisted from US exchanges, but they will continue to trade on OTC markets. Or if they go to, let's say, and start trading in Toronto Stock Exchange or Hong Kong Stock Exchange, I'll switch a broker which allow me to trade on Toronto Stock Exchange or Hong Kong Stock Exchange. Here's my personal feeling on it. And again, there's no political statements around here. My personal feeling is that if we try to delist, put a blanket order to delist any Chinese company, it's the US investors and the US exchanges who are going to lose more, will be harmed more than those Chinese companies. If we try to delist China, I'm sure TSX, our neighbor in North, is waiting with open arms to welcome Alibaba to list on Toronto Stock Exchange. Right? The stock exchanges in Europe will welcome them to list on Alibaba on European Stock Exchange. It's my feel is that it is us who may be able to lose, because now it will not be available to trade as frequently, or will not have as much liquidity as we want it to be, because it's not listed on exchanges. It'll become either OTC or we'll have to trade it through international exchanges. Yeah, so I hope the sense will prevail, and we won't take those drastic steps. Instead, what we should do is to figure out how can we get access to the books, if that's the whole point. Do you think Q3 result is better than Q2? I don't know. I haven't yet looked at in terms of what they have done, but I haven't seen any negative news around NEO yet. So it's very difficult to guess unless you are in a company or working for a company. We can make some intelligent guesses based on what's happening in overall Chinese economy. From that perspective, I think China should do better in Q3 because they have opened their economy much sooner. The folks are back to work. My neighbors, I was talking to him, and his parents are back in China. And he says, now they are not even, they don't even need to wear mask when they go out. So I'm like, oh, now we are still struggling here. And at least the, most of the China has been able to control it well. So if the economy is back up, people are ready to spend, and they are ready to spend on electric vehicles, and the auto sales will go high, then yes, there will be tailwinds behind all the businesses, not just NIO. All right, let's get into PayCom. Now, this is how I'm building my thesis. You're free to, take some things out of it. So on 7/14, I started looking at it, was bullish, but didn't do a deep dive into it. This we closed it. I added another trade. This is what I shared today. Okay, let's look at the company history. So we were started in 1998 when an executive from ADP, which is the biggest payroll processing in US, he left ADP, started his own company, PayCom. The initial focus was to make sure we can pay the employees. Right? That's exactly what they started with. Make the process of paying employees easier for companies. Right? Now, recently, they've also broadened, over last few years, they broadened into other areas. We'll look into the details of what other areas now they're looking at. Now, so actually this has changed in last 3 weeks. When I initially looked at PayCom, before mid of July, when I did my first trade, their mission statement was a little different. And then yesterday, when I wanted to update this document with the latest finding, I'm like, where can I find that mission statement? I couldn't find it. They were come with a new, which is now tell them that they are now more focused on, they want to focus more on beyond payroll. So now what they're saying, we are one HR and payroll solution for recruitment to retirement. Means a lot more optionality for the business than what they had earlier talked about, which was just payroll. And for recruitment to retirement means, and everything in between. So let's do a quick overview. They are a leading provider of cloud-based. I love businesses which are cloud-based because of the fact that the margins are high. We don't have to ship CDs, software CDs. Upgrading customers, much easier. You have the data of customers, you can mine the data and provide a lot more functionalities, much, much easier. I have heard in my professional experience in moving companies from when our company solution was from the on-premise, wherein we have to have our software deployed on a servers hosted by the customer to move them to the services that we host as a cloud-based SaaS. Our life as a company became so easy. The transition was painful for me because I had to manage the transition with the customer. But once we did that, life was fun. So I love the companies who provide cloud-based solutions or SaaS. Now, they not only provide the functionality on the payroll, but they also want to do is to expand beyond all HCM, human capital management functions, including talent acquisition, time labor management, payroll, talent management, HR, everything. Right? And that's why now they're trying to change what they stand for, not just payroll, but we want to do everything from recruitment, how you bring the talent in-house, how you manage them, and then, of course, right now, most of the revenue is coming from payment, but I want to now expand beyond that. Right? So they have a talent acquisition, talent management, payroll, HR management, time and labor management. Now the differentiation is that they are focused on small and medium-sized businesses. I think there was some question around how it's different than Microsoft, LinkedIn, and Workday. Microsoft LinkedIn is complete. They are not providing solutions for corporates to manage payrolls. At least not what I have seen. That Microsoft doesn't do payroll management. LinkedIn doesn't do payroll management for companies. I don't think they are the ones who are sending checks or doing direct deposits to employee accounts. Workday is a competitor, and we look into the competitors. Workday is one of them competitor, but Workday, etc., they're more focused on businesses which are large scale enterprises. And PayCom doesn't want to go there because there are bigger players like Workday and ADP already there. So what they are focused on, small and medium sized businesses. So it's like, and again, you can enter into any business segment which may be very attractive, but you also need to see how can you stand out, right? Do we want to be a small fish in a big pond? When I'm doing option trades, I want to be. But if I'm running a business, I may want to be, to begin with, I want to be a big fish in a small pond where I can establish myself, I can capture the whole market, right? And so they have to figure out where they want to spend money. Do they want to capture and go after those customers wherein ADP and Workdays are going, or they want to focus in a segment which have been not well served by ADPs and the Workdays, but have a similar need. So they are focused on small and medium-sized businesses, means around 50 to 5,000 employees. Like I said, main platform right now, payroll processing, but they do have an optionality. So it means they can expand beyond this business. A quick highlights from the 2019, they have a 26,500 clients. When they say clients, means if a company has a separate subsidiaries and each of them is running a payroll separately for their employees, each one is counted as a separate company, which I don't think that's a wrong thing to do. It's not that they're cooking up the numbers, right? It's the right thing to do. Those are our separate legal entities and they are running the payroll separately. Employees are separate. So these are individual clients, but they also provide a number that they have 13,500 clients based on the parent company grouping. If you group those smaller divisions into one parent company, still they have 13,500 customers, right? So it's not that they are a startup or they're just coming on the market. This company has been around for quite some time. They have amassed 13,500 individual big logos, or total almost double are those individual clients. And their annual revenue retention rate is 93%. I love that. ARR is one metric where SaaS companies get measured on, because we want to see how much, if ARR is lower, then it means you have to hunt to get new customers in the door always. Having a higher ARR, which is annual revenue retention rate, gives us more stability to business as such, because you know how much your next year revenue is already confirmed. Despite that, they had a revenue growth of 30%, year-on-year revenue growth of 30%. If I was talking of a company which is 5-year-old, still growing, probably won't be happy with 30%. But for PayCom, I think that's a decent figure. And not only just 2019, I think for 3 years they've been growing at a CAGR of 35%, which is good. That's a good growth. So quick numbers. 2019, the company currently has, we talked about it, 26,500 customer. Retention rate is 93%. And with the employee usage rates of above 90%, 90% or more of the employees actually use the other services. Of course, the company has to pay everyone, but then there are some services which employees also use. 2019 revenue per customer has continued the trend upward. So this is great. Not only you're increasing revenue, but you're also increasing what the social media platform will tell is ARPU, right? average revenue per customer. So they've increased their revenue per customer. Talked about yearly revenue rose 30%. It's $737 million. Net income rose 31%. And it is net GAAP income. Means they are profitable. They don't have to do, adjusted GAAP income to show it to be profitable. Adjust your non-GAAP income to be profitable. With the GAAP itself, they are profitable. So it's a profitable company, growing company, may not be growing as crazy as 70 to 80%, like some of the money losing companies are growing, but it is 35% CAGR is nothing to be sneezed at. I like that. Now, Q1 2020. So we looked at 2019, but look at, they announced their Q1 earnings in April. It increased 21% only because of COVID impact. And this is one thing which we'll talk again later is because of COVID, companies are letting people go, and they get paid on how many people's or how many employees are on their platform. So they will see some impact on because of COVID, but their net income it still grew, even though the growth in the revenue was less. I'm not saying that the revenue declined. What happened with Google this quarter? First time in the history of Google, their revenue actually declined. In PayCom, Q1 2020, their revenue didn't decline, but it increased by lesser percent. So it still increased. We'll have to see what happens in Q2 2020. I think they are due to report in this coming week. So I will be digging into it to see what happens. This is how they've been increasing their revenue. 2016, 2017, 2018, 2019. They ended 2019 at around $740 million. Major revenue source is per employee fee. We talked about it. Let's look at a quick question. Sorry, I saw a question from Eric. Why does Q1 include COVID impact? Because of March, changes would have been happened in March. Companies have already started laying off some of the people in February and March. So they did have some impact because of that. Probably maybe in SMB segments, things could have happened a little earlier. Or the other thing is they might have slowed down their hiring, if not fired people, which means again they would not have grown as much as what they've grown in the previous quarter. So competitive landscape perspective, ADP we talked about, Paychex, Workday, and there are some smaller innovative players. But again, these have like for example a company called Earnin. They have a different business model altogether. They are not really payment processors, but they could grow to become a payment processor. What if Workday figures out and they say, you know what, now we want to go into small and medium business segments. So it's not that there is no competition. They own the whole turf for themselves. That's not the case. They do have a competitive landscape. But like I said, they are focused on SMB segment, while the bigger competitors are serving the larger, bigger corporations across the world. Number two, they are GAAP profitable. Workday is still losing money. So if you are profitable, then it gives you a little more optionality on what you can do with that, right? You can, if you're profitable, you will not hesitate to raise some money, or basically you got an ability to invest. Also, not just GAAP profitable, they also have a cash available. So even if they don't buy businesses, could they use that cash to do a share buyback? Possible. I think they did that last year in 2019. So there is a more possibility of maybe doing what I term it as a shareholder friendly moves from this company. Could they give dividends? I haven't checked if they were actually paying dividends or not, but that's something which we can look at. Could they do share buyback, which is good for shareholders? They could. I mean, again, having cash on balance sheet in this time of crisis, it's a great, great asset to have. Many of the companies which are now struggling are because they didn't conserve their cash, right? The airline businesses, Boeing, they didn't conserve the cash when it was needed. So, but they are gap profitable, they also have cash. It looks like business tailwinds. We looked at their recurring revenue is great. Now, while companies are cutting costs, these contracts are multi-year contracts. At least I can only talk about my personal experience in the companies that I worked for and which have, SaaS business model. Our contract would be 3 years contract, right? So even if the companies, they cannot completely get out of the contract and, move to a competitor if they want to cut costs. If another competitor come and say that we'll give you cheaper solution, these contracts are legal contracts. So they'll still have to honor it. And if they're to cut costs, maybe they'll cut somewhere else than, canceling the contracts with paychecks, with PayCom. So PayCom also offset the revenue with the addition of new clients. What CEO reported in their Q1 was they are seeing and they are exploring more and more small business segments, while they're seeing a headwind from the existing one in the number of employee that on a platform going low because of the layoff. What they're also seeing is a good traction in strong addition of a new clients. The reason is in this crisis, if the new companies are looking to cut costs, why don't you outsource your payroll to someone who knows it how to do best? So that could be one of the reasons why they're also looking at that their sales, their pipeline, the leads is actually equal to what they saw it last year. Now, how many of that sales lead actually convert into customer, we have to see. Other business tailwind is their app, which helps managers supervise employees from their phones, right? It looks like, of course, they didn't target it for this crisis, but they had already building out these apps. You can download, go ahead to App Store and download PayCom's apps. One of the apps is how to manage your workforce from remote, right? From your phone, how you can, go through what, as a manager, it helps you. And now with this, people working from home, there's a lot of traction around that. And lastly, the report from industry consultants is the whole HCM market itself will grow. So not only this company has got some tailwinds, the market itself will be growing over the next few years. Things that we need to be aware of is they withdrew the guidance for full year. I'm not surprised. You don't know what your customer is going to do. Most of the companies have withdrew the guidance for this year, but just wanted to bring it up front that this is something that we should be aware of. The second thing is, like I said, they are very strong in a small and medium business segment. What if many of them may not survive this pandemic? So that's one big caution is if this crisis continue for long and long, way longer than we expect, a lot of these plans, a lot of these small businesses may not be around. So that's this is probably the biggest risk I would say you should focus on if you want to take a position in this one. And that's why, because of this one, I'm not going to do too big or, too naked or do a naked put on this one. A quick look on their P&L statement. Like I said, they are already profitable, almost 700. Let me increase it a bit. Okay. Almost $740 million, $740 million revenue 2019. Net income positive. Good to see. So from revenue and from income perspective, both things look good. They are actually generating net cash. They are from their operating activity. So it's not that they're burning cash, they actually generate net cash. And they have very less capex, so they have a good free cash flow. Next, if I look at, they got, like I said, they have a cash available. They got $133 million of cash on their balance sheet, which gives them a lot more optionality on what they can do with that cash. And if I really look at their long-term obligations, they have only $19 million of long-term obligations that I would be worried about. The other one which you see here, client fund obligations, is the money that they've received from their clients. $1 billion is the money that they have received from their clients, but it's an obligation because they need to pay this, use this money to pay their employees on and whatnot, right? So it is an obligation, that is why it is showing up on liability, but it will also show up in an asset. So there we go. But because their business model is that the clients pay them, if I've got 50 employees at an average salary of $5,000 per month, so I'll be paying them 200, whatever that number is, I can't count, whatever that $1 million is, I need to pay them so that payroll, PayCom can run my payroll. So that's $1 million, $1.6 billion money that they have. It's not theirs. That's why this is a liability. But what they can do with this money is something that we can see it. Where did I see that? Because I was curious on what that line item was. Maybe it was in cash flow. They actually use this money, invest some amount of it, right? 195 million. Maybe put those in treasury. You cannot use this all money and put it in the stock market, because if they don't pay the employees, they're gone. But out of $1.7 billion, does it harm to maybe take $195 million and put in some short-term investments, very secure, which will earn some revenue for you? I think that's okay. It's not too risky. I would be scared if I'm a client and they're putting this money in stock market or in Kodak, but they're putting very small amount of money and generating some income. So for example, last year they generated $69 million, because this is what many companies like insurance companies do all the time. This is what the float that they enjoy. So which is what I like. The treasury function is making good use of the money that comes in. Let's look at the stock. Before that, let's look at a question. Okay, Eric says, following up on PayCom Q1 code. Okay, all right, yeah, thank you. So yeah, I didn't read this, but it looks like that's probably what would have happened in this one. Okay, their stock, it's up, but not as up as some of the other SaaS companies, up 50%, 60%. Year to date, it's up 20%, but still way below than their 52-week high. Just to be aware of what the stock market, how the stock is looking like. So if we were to initiate position, would I want to initiate the position when it is at like 340 or 330? Now it is trading at less than $300. The other thing that we need to look at is stock has been up 800% over past 5 years, up 75% from the 52-week low in April. Oh, we can ignore that one. I mean, every company, there are some companies which are more than 100% up. Like I said, it could stay volatile if COVID situation does not improve. More layoffs, highly dependent on small businesses. How many of them will survive? So it is not a risk-free investment. But this is one stock which is, I like it as a SaaS, the recurring revenue, their balance sheet is strong, and if economy improves, I think this is the one which I want to build position on. And that is why I started building my position on PayCom. I went with a put spread, right? So that, if it falls too much, I have an option to exit. So think through it. If you like it, maybe start small, maybe buy a few shares. Don't go all in. All right. With this, I think this is the end of our session today. I still have time, 15, 20 minutes. This brings to end of my analysis. And this was our last section. But I will be here. I can answer questions, or if you want me to look at some trades, we want to talk about it, discuss it. It's an open forum. I'm so glad that we got some time for open forum. We didn't get time. This is our extra time which is available. Let me put it that way. So we're past our regular 2 hours. So feel free to drop off. I don't want you guys to hold you guys, but I will be around for another 20 minutes. Then I have a hard stop at, I need to get back and do some of my parental duties, but I'll be here for another 20 minutes. So let's look at some of the questions. Conservative trade on PayCom, sell 21st August. So here's first thing, Sumit, I won't do any more positions in August. The reason is, number one, PayCom is announcing earnings next week. And earnings could after earnings, stock could go anywhere. So last week we did an analysis of many of the earnings and the fact that how wrong we could have placed our bets thinking revenue is high, earnings is high, everything is high, stock should go ahead. So earnings are coming up. So stock could go anywhere. We don't know where it will go. So I want to give myself a little more room to be correct. Because if you're doing only August 21st, then you have not much time to defend the trade if it goes against you. But if you don't mind getting assigned at that and holding it, could be fine. So let's look at the trade. You said sell August 21st, 300, 310 call spread. Let me get rid of this. It's not in it. Yeah, if I were to do right now, I'm only defending trades in August or closing my profitable trades in August. Any new trades, I'm already in September. Because again, if you're a day trader, all power to you. If you can look at the trades, but I'm looking from perspective of, I can say to hold in front of my laptop to manage it. 270. Yes, you're right. So you get a $12 of premium. You have, where did it go? Oh, sorry, I'm hiding simulations. Okay. So yes, but look at from on August. Let's look at August. What's the expected move by August? It's not way below the expected move. So yeah, so if you want to do an August trade, this is what I think Sumit is referring to. So if stock falls below your break-even point, which is 270 minus 12, which is 258, you will become a proud owner, or maybe a forced proud owner of PayCom shares. So make sure you have an ability to hold 100 shares, because stock could go down, let's say 200, 220, 210. We don't know. Make sure your portfolio can hold this, because if stocks start to go down, there is not much of a defense time left in this trade to reduce the risk further. So if I were to look at this, probably I'll go over to September and give myself a little more room to be right. If stock fall it, I have a little more room. Secondly, I'll have more time to defense. Yes, worst case, you own the stock at 258. Yes, that's the case. And you should be okay. Sumit, what if PVC closes at 240? Yeah, then if it goes to 240, I think, yeah, if you don't mind holding at 258, that's fine. So I don't know what you meant by Sumit when you say, I think it's an alternative to cash secure put, means you just don't want to do only put. You also want to do call spread to collect little more premium and won't mind sacrificing some of that premium if it blows through your call spread. Yes, then this is a good strategy. I do it in some of the stocks which I don't mind holding, because you run up the risk of, let's say, stock falling down and you don't have any protection. So be really mindful of how much is your account value. This is not a cheap stock. We're not talking about $40, $50 stock, right? This is a $300 stock. So you really need to have a big account size. Okay. All right. A question from Deepak. Deepak, is this your first time here? Or maybe second time? Let me go through the question. Are you into algo trading? No, I am not. Sorry, yeah, I don't have any feedback on that. I am not on algo trading. No earnings surprise coupled with management guidance to effect will revenue continue. Yeah, we don't know what will happen at earnings. It's always, earnings is always a mystery. Especially what the stock will do after earnings is always a mystery. Okay, chip stocks, chip sector. Chip sector has, I think, already run up too much in recent time. If I look at an ETF, whoa, look at the strength in SMH. So I won't go, full bullish on SMH at this point of time. If I were to do anything, maybe I look at a wide iron condor on this one. So let's say we will take a positions on chip sector. Maybe go to 25, 155, 145, then 175, 185. It actually has a decent premium. Well, let's look at what's the okay, because the probability of profit is little less. But if I were to do anything on SMH, I would rather do on a chip side, I will do a defined risk trade. Pull back. I think the individual companies will have to look at in terms of which companies have run up how much. AMD has blown everything through the roof, but looks like Intel's, it ate Intel's lunch. So AMD is good. NVIDIA, again, I think that also has gone too high, but it seems, they're already started to consolidate. Whether they will fall down or not, I don't have any opinion, but this sector does have a tailwind behind it, right? With all 5Gs and a lot of growth in data centers. To run all the servers, you need chips. So there are tailwinds behind it, but it could consolidate. So if I were to do anything in any of the chip companies, I would do different risk. Yeah, Qualcomm, Taiwan Semiconductor Manufacturing, TSM. Yeah, selling a call spread 80, 82. Yeah, we could look at that. Qualcomm, it already moved up. I think Qualcomm was up, what, 18, 20% because of their settlement with Huawei. This was a huge move that they had. Oh, let's see. So they had a big move around here of almost, yeah, 14%, 15% move after they announced a settlement. Roku, I will put a trade. I played Roku this year already 2-3 times and had a decent trade. I know it is announcing results, so that's why I closed my bullish trade. I think we talked about it last week. Last Saturday we talked about it. I closed my bullish trade and I mentioned I'll probably do another trade near to earnings. Make sure all the IV juice is in there. So I will do a Roku trade. And again, Roku, it won't be earnings trade. I will still go all the way out to September. And I don't mind owning Roku at, if I will pick it up, I'll probably pick it up 120 or 125, 15 to 18 delta. That's a price point. Probably I will do put. Again, education opinion only. My account can hold this naked put. So that's what I'll probably do, a naked put. It's results is on what? It's on Monday. Is it Monday? Post Monday. Let me see. Thank you. I don't think Abhishek is in there, but he's been doing a community service by posting this earnings. Where is Roku? I don't see it on Monday. Oh, it's actually on Wednesday. Roku is on Wednesday. Yeah, so a lot of company which I have positions in: Roku, Square, Etsy, Zynga. So, and then before close, Mercado Libre. Oh, Wednesday gonna be a busy day for me. Question: Qualcomm at 105. What trade you're looking for at Qualcomm, Sumit? And Qualcomm is currently 105. Are you basically looking at you want to sell the put or? Yeah. Oh, okay. So Dave, I have 190 naked call, just closed out the 135 naked put on Roku. Okay. I know, I think Kunal is not here. He had a covered call on Roku. So there is no upside risk, but I think he bought back the call to just ride few more days while Roku goes up. So yeah, I don't have any position. I closed all my positions in Roku when they hit my profit target, because then I know as it gets closer to earnings, the wall will increase, which will go against us as a option seller. So I closed my positions before it, and I thought I'll wait for the wall increase to happen, and then I'll put on another trade. So Roku is on my target list. Other one, I don't know how many of you have. I don't see many of talking about it, but the other company, which is Mercado Libre, probably someday I will do a deep dive in this. I've been in Mercado Libre for a couple of years, has done very good to my portfolio. If I were to summarize it, Mercado Libre is Amazon plus eBay plus Square plus PayPal. There was more company. Add all these and you get Mercado Libre in Latin America. That's what they are for Latin America, what these all 4-5 companies are. So I'm extremely positive about this. Share has run up too much in the recent times. I mean, I initiated it at $300. Now it is, I think, around $1,000 or something. But I'll continue to hold my positions in this. So interested in Mercado Libre. What do you think the play is on Apple after the big move? So Apple is announcing, they already announced their split. The split will go effective on I think 31st, August 31st. I still cannot wrap my head around that Apple is $1.82 trillion company. It was $1 trillion just like not so long ago, and now it is almost 80% higher. So there is a euphoria. There again, the other thing is there's the China effect. Where else you will go? And if the split happens, could Apple move further higher? Possible, very much possible. So I'm not gonna go short on Apple. Only not gonna go further short on Apple. I'm already short on Apple because that's give me balances my portfolio. But if you want to do stay defined risk on Apple, it's $420. It's to me it's too big a price right now. But we have seen like stock can stay insane. I generally say stock can or markets can stay insane longer than the account can stay solvent. So I won't trade against the market. I'll stay defined risk. But at this point of a time, I'm not going to put my money on Apple. Like I haven't put any money on Nikola or Kodak. It may run with some more RS people continue to pile in, of course. And if we get clarity on additional stimulus, I wasn't reckoning what exactly happened on that one. I thought there is no decision happened just yet. But if Congress decide to continue that additional unemployment insurance, many of that money might still come back in stock market. So that could happen. Ramesh says that Marvel, Nokia, Ericsson is a good for 5G. Yes. So maybe I think one day we should do a 5G basket. Look at the stocks that could benefit from a 5G. One is who are the companies that are in providing I would say the innards of 5G chipset, companies providing chips or frequency cell towers or companies like Ericsson, Nokia. Number two, what are the companies that are in making use of these technologies and creating products out of it, like Apple? What are the other companies could be? Could there be like Microsoft? Could 5G, accelerate the use of, let's say, HoloLens something? Will augmented reality benefit from 5G coming to this? So we can look at that companies who build products using in which 5G has a use. And then maybe there's some of the services that could benefit just from the fact that internet has become super fast. Yeah. Maybe someday we should do a 5G basket. Dave says, yeah, I'm in a volatility club. Yes, I am. In fact, the idea of starting this particular forum came from the volatility club because some people started asking, how do we get started in options, basics of options. I volunteered. I said, okay, I will start sessions on to talk about options. And that's how, Dave, it started. And then now we have moved, beyond just talking about options to a much bigger area on analysis of stocks, etc. But yes, I am part of that. I attend that one. And the genesis of this is actually some of the folks from the volatility club learning, expressing their desire to know more about options, not just buying options, but how to overall manage option portfolio. So yes. Yeah. Oh, or are you? I like your session better than kids. You have been very generous with your words, Dave. But I'll take it. Thank you very much. Yeah, I'm just trying to make sure I can share what and believe me, this makes me a better investor. For example, if I were not to talk about PayCom here, why would I spend time and doing that analysis? And I learn so much because I know I have to think, I need to present this. Let me understand what a balance sheet is. So I go and find out, how do I read about a balance sheet? What are the things to look at it? Like I said, my background, I'm not an accountant. I'm not a financial advisor. I'm not don't have investment management experience or an Ivy League degree, but this is how I learn. Yes, I will share the Google Doc links. I don't know if you are in our Slack group. What I do is, once this is done, I'll come back and share all the documents, like main document, backdoor IPO, Rocket Companies S1 that we reviewed, and then I come back and I'll share it. The deck we reviewed is available here. So for part of this, I will put the information about the links to these docs on the Slack group. 61 on Slack, put sell after. So Naresh, like I said, stay small. I am bullish on Slack. I've been selling puts, selling calls, reducing my cost basis. Long term, I'm still holding Slack. I have a put position Slack. One thing I'll tell you, don't go overboard. Only the reasons I've seen people losing the houses because they become too big in their positions. How do you see selling FB 918, 230 put and 300 call? Okay, one thing on the stocks, and this applies not to FB. I think I should put this out because someone else pinged me on Disney, some similar stock. So you're saying 190, 230 put. Where is 230 put and 300 call? 300 call. First thing first, and this is not for FB, and this is coming from experience of talking to some of the more experienced traders that I'm in touch with. In stocks like FB or any stocks which are individual company stocks, I would refrain from doing a naked call. Right? Just from the fact is 300 might seem too far out for FB to reach. If I really look at your it is way beyond what the market is currently expecting, right? It's way beyond the expected move. It's got a decent probability of profit. Is 70% pop in this one. So just from that number perspective, I would say, yeah, that number look good, but here's the risk. What if someone comes and say, FB announces, either they announce an acquisition of another company which is going to blow their future revenues, to unexpected levels. Or what if, and I'm just putting a hypothetical scenario, I'm just trying to bring home the point is stock FB can go $100 higher tomorrow, depending on what might be happening in the boardrooms of big companies. We never know. What if lawmakers come back and say, we need to split FB, and now FB become Facebook, WhatsApp, and Instagram as 3 separate companies. As an investor, I would love that. What stock becomes $400? You're exposed to a much larger risk on the downside. So if you're going naked on this one, be very, very cognizant of the fact that the stock could jump. You never know. And this is, I had lost something, and I'm happy to share. I talked about Mercado Libre, right? I owned that share at $350. And it was around 420 or something in 2019. And it was announcing results. I sold, and I didn't own 100 shares, but I owned some shares. So, and I went ahead and sold, I think 580 or some call, and then sold a naked put. I'm like, it's like $400. $400 share doesn't, jump 200. Boy, I was wrong. So I had to defend that position. I lost like say $5,000 in that. because I had to close it and all that. But $5,000 is, I would say, a cheap lesson for me to learn. One of my other friend, he lost an SUV in Budweiser because Budweiser got acquired by Anheuser-Busch, and then suddenly stock jumped higher. So don't go naked unless you're an institutional investor and know how to manage the risk. I would, if I were to do this trade, I would do this one instead. You know, probably pick 320 here. What am I sacrificing? I sacrifice maybe $30, but I would have contained my risk. And this is, instead of doing that naked one, now I don't care if FB goes 500 wherever, my risk is contained. And I'm sacrificing what? Just $30. Rather do this. Okay. Oh yeah. For me, education, I'm of a, because I learned for free, Taste of Trade, YouTube, and Dave, you're right. And again, now we are out of time, no more trades. We're just talking, you know, somehow, at least I started my option journey. I had to give up Facebook and Netflix because I wanted to find time along with my job. I'm like, where can I find time? I gave up Facebook and I never returned back. I gave up Netflix, and all I used to do was to watch a lot of YouTube videos, watch Tasty Trade every day, without fail, at least, you know, 90 minutes minimum. Did it for years. Now I've returned back to Netflix. I do watch a movie a week, you know, spend maybe 2 hours on Netflix, but I've not gone back to Facebook. I know I don't spend, you know, that much amount of a time, but my again strong feeling was, hey, from an education perspective, it should be free. I want to basically talk about how you can build your trade. But if you want me to, I'm okay with the people who are sharing the trades and charging for you for that. But in terms of teaching, it should be free. So that's my goal. So, cool. I think we just reached 12:59. That means I have just only 30 seconds. I appreciate all the good feedback. Thank you very much. Yeah, I mean, my idea is, hey, as a part-time trader, this is, I was always told by some of my friends that this is too risky a field. And kind of, I was probably, you can say, and my wife says that I was in a midlife crisis. So I had to pick something. Instead of, you know, buying bikes or buying a Porsche, maybe I picked up a little more riskier stuff in life, which is option trading. So, so that's exactly what was my genesis when I hit my midlife crisis. But then I realized there is so much of a misconception around this, saying this is too risky. I find it as a tool to reduce the risk. But of course, it's a tool. You can cut yourself or you can defend yourself with a sword. So the idea is, which side are you holding the sword? If we learn it in the right sense, we know what the risk is, then why as a retail investor, we should not be in this trade. I think one of the boot camp, I think it was the first boot camp. I want to share that. Oh, by the way, those were completely new. We also have a separate series we have started on boot camp where we only talk about option education because we don't find time to do this in this forum. So there's a separate boot camp series. Someone asked me in a boot camp that if selling a put is such a better way, then, you know, it's so powerful way to obtain the stock at a lower than the current market price. Why don't everyone does it, right? My answer was, not everyone knows about it. And that's what we want to do through this forum, is to share with the retail investors. And then lo and behold, I was attending a conference, Money Show online conference for accredited investors. And one of the money manager comes and talk about 2 secret special strategies, and they explained how they make use of those special strategies to generate alpha. Those were puts and the covered calls. And they said this fund is open only to accredited investors, and we will charge 2%. This was called, I think I pasted in a Slack. This was called diversified some return. Like what? Why would you pay 2%? Money managers do it all the time. We can do it. If we learn how to use the tool, we can do it. Yeah, that was my midlife crisis. Once you reach at that stage, now I'm on the mature side of 40s. I won't say on the wrong side, but on the mature side of 40s. Kid going to college, kid is in college. So that's where I am. So exactly, I started option trading, learning option trading, taking some risk in life during my midlife crisis. All right, cool. That's it. I think no further questions. Appreciate all the feedback. Cool. So we got a lot more folks from East Coast. I know there are folks from Michigan. Good to see you, folks from New York. 15 years ago, I spent almost 18 months in New Jersey. And I don't want to go back there, especially, in November and all the way to March. I'm happy in California. All right. Thank you, everyone. We are way over time. We'll talk to you. Those who are in a boot camp, I'll talk to you again on Wednesday. Otherwise, we'll be here on Saturday. All right. Where's the Zoom setting gone? And Naresh says we have furnaces. Cool. You're welcome, Rana. Okay. Let me stop.